Few years back, in the bustling city of Washington, two friends named Alex and Peter were deep in conversation at their favorite coffee shop. Both were young professionals who had recently come into a sum of money and were eager to make wise investments for their future. However, they were torn between two popular investment strategies, SIP (Systematic Investment Plan) and Lumpsum investments. Alex was a meticulous planner, always preferring a systematic approach to everything he did. He believed in the power of consistency and stability. On the other hand, Peter was a risk-taker, known for his bold decisions and adventurous spirit. He believed in seizing opportunities and taking calculated risks. As the friends sipped their steaming cups of coffee, they engaged in a lively debate. Alex argued in favor of SIP investments, explaining how it allowed for the systematic and disciplined allocation of funds. He emphasized that by investing a fixed amount at regular intervals, they could take advantage of the benefits of rupee cost averaging. This meant that they would buy more units when prices were low and fewer units when prices were high, leading to a potential reduction in the average cost of their investment over time. Ben, however, had a different perspective. He passionately advocated for the lump sum investment approach, pointing out that it had the potential for higher returns. He believed that by investing a significant sum all at once, they could capitalize on market opportunities and potentially benefit from any upward trends or growth in the market. He argued that this approach could yield greater profits in a shorter period, providing them with more financial freedom and flexibility. The debate continued late into the evening, with each friend presenting compelling arguments to support their chosen investments. Suddenly, a wise old man sitting nearby overheard their discussion. Intrigued, he approached their table and kindly offered his insights. He shared that the decision between SIP and lump sum investments depended on several factors, such as their risk tolerance, investment goals, and market conditions. He advised them to carefully evaluate their financial situation, conduct thorough research, and seek professional advice before making a decision. Alex and Peter listened attentively, realizing the importance of considering their individual circumstances and long-term goals. They thanked the wise old man for his guidance and bid him farewell. Hello friends, welcome to the channel, and today we are discussing the pros and cons of SIP and lump sum investment. There is often a debate about which option or style of investing to choose. The investor often gets confused and always thinks in the long run he should not lose at the benefits. Man is always greedy and he is also fearful. He wants the best of both and never satisfied. Let's discuss both options. SIP stands for Systematic Investment Plan, where you invest a fixed amount at regular intervals, while a lump sum investment involves investing a larger sum all at once. Let's consider the advantages of SIP first. Advantages of SIP include 1. Rupee cost averaging. By investing a fixed amount regularly, you buy more units when the market is down and fewer units when the market is up. This strategy helps average out the purchase price over time. 2. Disciplined approach. SIPs encourage disciplined investing as you commit to investing a fixed amount regularly, regardless of market conditions. It helps in avoiding emotional investment decisions. 3. No market timing. Since SIPs spread investments over time, you don't need to worry about trying to time the market. It reduces the risk of investing a lump sum at a market peak. Now let us consider the plus factors of a lump sum investment. 1. Potential for higher returns. If you have a large sum to invest and the market is expected to perform well in the near future, a lump sum investment could generate higher returns compared to SIPs. 2. No time restrictions. With a lump sum investment, you have the flexibility to withdraw your funds at any time. SIPs have a lock-in period, and early withdrawals may attract penalties. 3. Convenience. If you have a lump sum available, investing it all at once saves you from the hassle of managing multiple SIPs and associated paperwork. Both SIP and lump sum investments have their merits, and the choice depends on your individual circumstances and goals. Here are a few factors to consider when making your decision. 1. Investment horizon. If you have a longer investment horizon, SIPs are generally considered more suitable as they allow for rupee cost averaging. For short-term investments, lump sum investments might be more appropriate. The regular investments over time help mitigate the impact of short-term market fluctuations and allow you to benefit from the power of compounding. 2. Risk tolerance. If you are uncomfortable with market volatility and prefer a more disciplined approach, SIPs can help mitigate risks by investing at regular intervals. On the other hand, if you can handle market fluctuations and have a higher risk appetite, a lump sum investment might suit you better. This approach allows you to take advantage of market opportunities and capitalize on potential market upswings. However, keep in mind that investing a lump sum also exposes you to the risk of market downturns. So thorough research and diversification are crucial. 3. Financial situation. Your financial situation plays a significant role in determining the investment method that suits you best. If you have a substantial amount of money available that you don't require for immediate expenses or emergencies, a lump sum investment can be a good option. By investing the entire amount, you have the potential to earn higher returns if the market performs well. Now one question comes in human mind. What if I don't have a large sum of money readily available? If you don't have a significant sum at your disposal, SIPs provide the advantage of investing smaller amounts gradually. This approach allows you to enter the market and benefit from rupee cost averaging. SIPs provide flexibility and discipline. Let's continue exploring the factors to consider when deciding between SIP and lump sum investments. Market timing is a critical aspect to consider. It is the strategy of trying to predict the best time to enter or exit the market based on anticipated market trends or price movements. In the context of mutual fund investments, trying to time the market can be challenging and risky. It involves making investment decisions based on short-term fluctuations and speculations about future market movements. This approach requires accurately predicting when the market will be at its lowest point to maximize returns. With SIPs investments, you don't have to worry about market timing. Since you invest a fixed amount at regular intervals, your investments are spread out over time. This approach helps mitigate the risk of making poor investment decisions based on short-term market fluctuations. You benefit from a strategy known as rupee cost averaging, where you buy more units when the market is down and fewer units when the market is up over time. This averaging effect can lead to a more favorable average purchase price. On the other hand, lump sum investments require a decision about when to invest the entire sum. it becomes crucial to accurately time the market to maximize returns. However, accurately predicting market movements is extremely challenging even for experienced investors. Making a lump sum investment at a market peak can result in potential losses if the market subsequently declines. It's important to note that while SIPs eliminate the need for market timing, it's still essential to choose the right mutual funds and regularly review and adjust your investments based on your financial goals and market conditions. As you can see the advantage of removing the burden of market timing, it definitely makes SIPs more appealing for me. Indeed, SIPs can be a suitable choice for many investors due to their disciplined approach and the benefit of rupee cost averaging. It is essential to evaluate your individual circumstances and consult with a financial advisor to determine the most appropriate investment strategy based on your financial goals, risk tolerance, and investment horizon. There was no one-size-fits-all answers, and that the decision would ultimately depend on their personal preferences and objectives. Remember, investing in mutual funds requires careful consideration and a long-term perspective. We hope you found this video informative and gained a better understanding of SIP investing and lump sum investing. If you enjoyed it, give us a thumbs up. Subscribe to our channel for more investment insights. Thanks for watching, and until next time, happy investing.